China syndrome and its impact on Los Angeles economy and the housing market. So the first question is, what is going on in China? In short, I think China's economy is in trouble. The current GDP growth rate is anything but government official number of 7%. Some people say it's 5%, some people say it's 3%, some say actually it's 1%, and some say actually it's negative. So we believe actually it could be in contraction and in recession right now. So let me show you this. This is very popular and more trustworthy China output PMI, Purchasing Management Index. So the black line is the composite index including services and manufacturing. Actually, when it is below 50, it means it is contracting. So right now, we think China is in contracting. So we have been saying this for years, and right now everybody believes what we said before. The China's past investment and export-driven growth model cannot continue. So right now, the key driver of future Chinese economy resilience is on its household consumption. So we think if Chinese consumption growth can remain robust, like above 6%, 7% real consumption growth, China's median GDP growth could reach 5% at best over the next decade. However, if not, I think China's GDP growth could be trapped at 2 to 3% at best. Okay, so right now let's talk about China's housing market, which is the main driver of Chinese economic growth over the past several years. So in short, China's housing bubble is deflating in most cities. So over the past year, 67 out of 70 cities in China's home price had declined. All right. So let me give you the idea of a Chinese housing bubble. So in this chart is China's 8 first tier, second tier cities home price index, similar to our cash-share index. So let me show you three first tier cities: Shenzhen, Beijing, and Shanghai. All these three cities over the past 9+ years has seen their home price increase by more than 330%. Translate to the compound annual growth rate is about 17%. Okay, if we look at like a major 8 cities, average is increasing by 227%. Translate to the compound growth rate 13%. So let me give you a comparison for our housing bubble from 1997, the trough, the bottom of the home price, to the peak 2006, also 9+ years in the United States, 10 cities. It increased by 190%, and it's about 12% annual growth rate. Okay, so if we realize U.S. housing market bubble was serious, then China's housing bubble will be more troublesome. So looking forward, we think the room for China's housing return and continued appreciation is very little. Yeah. Okay, so right now let's talk about stock market. So we have seen the fiasco over the past several months in China about their stock market roller coaster and government's intervention. So here, let me show you this green line is China Shanghai Stock Composite Index from the beginning, 1991 today. So actually, we have seen several crash in China's stock market, and it's very volatile. So it crashed in 1992 and 1994, and serious crash in 2008, and this is the recent crash. So and also it experienced 5 years, 6 years long bear year in China's stock market. And let me give you a comparison again. This is United States S&P 500 index. So compared to green line, China, and blue line, United States, you can see China's stock market is much more volatile because of their investment behavior. I can tell you, most of investors in China, they are just like the wolf of the Wall Street. Most of them. And the government is even like another uncertainty. So looking at this holding period, the annual compound growth rate in China is 13, almost 14%. United States is 7.2% for the same period. So China seems very good, but don't forget, China's economy was 10% growth. Ours are 3% growth. So actually, I want to show you this so-called, in academic, we have this so-called Sharpe ratio, which is the risk adjustment return. The formula is stock market return minus risk-free rate, consider about a risk-free investment, divided by volatility of the stock market return, which is standard deviation. So we can say the higher the Sharpe ratio, the more risk-adjusted return, more favorable for the investor. So this is China. Actually, the 1 year return is negative, is not good. And 5 years is 1.13. And United States, 1 year is 1.04, and 5 years is 2.04. So investing in United States stock market in terms of risk adjusting in United States is much better than investing in China. So I would say unless you are like a private equity or hedge fund, you are work for Wall Street. Otherwise, if you are mutual fund, pension fund, you need to think about investing your money in China's stock market. Okay, so next question is, how will China's turbulence affect Los Angeles economy and the housing market? We think in the short run, it will not affect Los Angeles real estate. As we said before, investing in China, whether it's a housing market, whether it's a stock market, looking forward, we were gonna see more downside risk. So compared to China, investing in the United States is safer, is better in terms of expected returns. However, it could have some kind of negative impact on Los Angeles, export, trade, and tourism, especially consider about our strong dollars. Okay, so here is Los Angeles ports, imports, and exports. The blue line is imports. Doesn't change much, it kind of has some kind of upward sloping trend after the Great Recession. But you look at the red line, which is exports, actually we can see some kind of decline over the past year. And mostly it's coming from weak Chinese economy. Okay, and here is LAX air cargo departure and arrival. You see, is a little bit weak recently over the past several months. And this is LAX passenger departure and arrival represent the tourism. Also, we started to see some kind of decline after 8 years bull market. Okay, so right now the final question I want to talk about in this presentation is this question facing the rising and expensive home price in Los Angeles. People ask this, is Los Angeles in another housing bubble? And my short answer is no, at least not this year or next, for several reasons. Number one is macroeconomy. As we have heard from our previous speakers, they all say our economy, whether it's 2%, 3% growth over the next 2 years. So we got some kind of economy to support the housing market. And number two is demand and supply. As Jerry said, we had this great amenity in Los Angeles, so there's some kind of fundamental to support the demand. And supply, maybe next panel we'll talk about the supply. We got a problem of a shortage of supply in Los Angeles as well as the rest of California. So, so we got this demand and supply thing. And right now, let me show you this chart. So this chart is the Los Angeles County median home price, real home price, which means adjusted by CPI inflation since the data's beginning, 1975 today. So you can see over the past several decades, we see 3 bull markets, okay, and followed by 3 bear markets, all right. And we can say by taking the average, we see usually bull market lasts for about 7 years on average, and with 65% real appreciation. And then bear markets usually is 5 years. So we can see in 2000s, the bull market lasts longer than before and with much higher appreciation because unprecedented low interest rate. So right now, where are we? Right now, we are in third year of housing recovery. And so far, we have seen 30% of real appreciation. So actually, if you can kind of see this kind of hypothetical trend, we are just get back to this trend. So that's why I think, we are not in a bubble yet, So hopefully in the future, we don't see some kind of overshot, big swing, and then we might see another bubble. If the home price can steady increase, slowly, that would be pretty healthy. Yeah. And finally, I want to give you some kind of fundamental index in terms of a housing market. This is so-called price-to-rent ratio. It's a median home price divided by an annual median rent. So Los Angeles right now is 17, which is higher than national average, about 11. So it seems high. But compared to 2006 housing bubble peak, at that time was 24. So we are still lower than the peak, far below. And compared to right now, Manhattan is 25, Brooklyn is 23, San Francisco 21, San Jose 22. So Los Angeles is not that bad. Okay. Beijing right now is, China capital is 40. Yeah. It's crazy. Yeah. In China. So so we talk about this affordability issue. It's very expensive for middle class and poor Los Angeles residents. But we need to understand there's a term right now. We are talking about this so-called superstar cities, and I believe Los Angeles becomes one of them. It means the home demand are not just driven by the local residents and workers. They are driven by the global elites, global international investors, which had a lot of wealth. They want to diversify their homegrown wealth. And then Los Angeles definitely is one of the good place, especially for Chinese investors. Okay, so, conclusion. Number one, China's economy, housing market, and stock market are all in trouble. Number two, if China can transition to a consumption services-based economy, its median GDP growth can reach 5%. If not, its growth will be trapped in 2 to 3% over the next decade, unfortunately. Okay, and considering China's risk, investment in the United States will produce higher risk adjustment returns. And China's turmoil might reduce export and tourism growth in Los Angeles, but I believe China's investment in the Los Angeles real estate will persist. Okay, and finally, I believe the Los Angeles housing market is not in the bubble right now. Bear market will not come this year or next. All right, thank you very much.